have exciting news. I just opened my first Roth IRA account. Now, if you have no idea what that means or why you should even care, then stay tuned for the rest of this video where I'll explain to you how I plan to use this account to become a tax-free millionaire and how you can do the same. So let me start by just explaining what a Roth IRA is. An IRA is an individual retirement account. And the reason it's called a Roth IRA is because it's named after Senator William Roth from Delaware, who played a big part in getting this type of account created. If you're under the age of 50, the IRS allows you to contribute $6,000 every year of after-tax money into your Roth IRA. If you're 50 and over, then you can contribute $7,000 a year. There are a lot of benefits associated with having a Roth IRA. I already mentioned the number one biggest benefit, in my opinion, which is the fact that money in this account grows tax deferred. So when you want to withdraw money in retirement, you don't have to pay taxes on the money that you take out of that account. If you were to have a traditional 401k or a traditional IRA, all of that money is pre-tax. So when you want to withdraw that money when you retire, you owe taxes on that. And that is being taxed as personal income, which at the current tax rates could be as high as 37%. With the Roth IRA, you can withdraw money that you contribute anytime you want. There's no age limitation. There is just one stipulation about funds that you contribute to the Roth IRA through what's called a conversion, and there's a 5-year blackout period associated with converted funds, but I'll go into that a little bit later in the video. One of the other benefits of this account is that it's a personal account, so anyone can open it. It's not tied to your workplace. You can just simply go online to Fidelity or Vanguard or Schwab, and you can open up your own account. So far, the Roth IRA sounds pretty good, right? So why doesn't everybody have one of these accounts? Well, for starters, there are a couple of important limitations to know about when it comes to the Roth IRA. The IRS limits the amount of money that you can put into this account. So like I mentioned earlier, there's a $6,000 limit if you're under the age of 50, and if you're 50 and over, you can put up to $7,000. So when you compare it to the limits that the IRS allows you to contribute to, like a 401k or a 457b, which is currently $19,500, then that's a significant difference in the amount of money that you can contribute. One of the limitations of a Roth IRA is that any money that's earned through interest can't be withdrawn before the age of 59 and a half. So I mentioned that you can withdraw any contributions anytime that you want, and that's always the case. But if you were to have earned $23,000 in interest, then if you wanted to withdraw any of that $23,000 of interest before the age of 59 and a half, you would actually have to pay taxes on that money and a 10% early withdrawal penalty. Now, there are a couple of situations that would allow you to withdraw that money earlier than the age of 59 and a half. And that's through what's called a qualified expense. And this could be anything from a medical expense to expenses related to education, or if you wanted to use that money as a first-time home buyer, you could withdraw those funds and then not owe the penalty. One of the other limitations of a Roth IRA is that depending on how much money you earn each year, not everybody's eligible to make Roth IRA contributions. So starting at $124,000, there's a phase out where you're only allowed to contribute a reduced amount. And then at $139,000, you're actually not allowed to contribute at all. So when I talk about how the IRS has limitations on who can contribute to a Roth IRA based on your income, it's important to understand that it's not based on your gross income. So if your salary is $125,000 a year and you're thinking that you make too much to contribute the full $6,000 a year to a Roth IRA, you're probably actually allowed to contribute the full $6,000 because the income limitations are based on what's called your modified adjusted gross income. And that's basically just your income after you've taken out any deductions such as paying taxes, making 401k contributions, making HSA contributions, paying for alimony. These are all things that when you do your taxes, reduce your modified adjusted gross income. So to truly be ineligible to contribute to a Roth IRA, you'd probably have to be making well north of $140,000. So that's something to keep in mind when you do your taxes each year. You'll be able to see what your modified adjusted gross income is. So use that when you're determining whether or not you're eligible to contribute to a Roth IRA. So let's get into the good part of this video where I tell you how utilizing a Roth IRA can make you a tax-free millionaire when you retire. Let's take a look at the example of a 25-year-old who, understanding the tax advantages of having a Roth IRA account, opens an account and contributes the maximum $6,000 every year. If they were to make those contributions every year from the age of 25 to 65, so that's 40 years of contributions that they're making, assuming that they get 7% return on their investment, they'll have over $1.1 million in their account. And the reason I always assume a 7% return on their investment is because that's just historically what the stock market has averaged on returns when you account for inflation. So let's get into the really good part of this video, and that's where I explain to you how I plan to use this account to make me a tax-free millionaire when I retire. So I mentioned earlier that I just opened my Roth IRA, and I'm going to let you in on a little secret. I'm not 25 years old. And the reason that this is important is because if you take a look at an example of a 35-year-old who opens their Roth IRA and contributes the same $6,000 every year and gets the same 7% return on their investment, since they opened their account 10 years later, they're only investing for 30 years versus the 40 years that the 25-year-old had to invest. Because of that delay in opening the account, when they reach the age of 65, they'll have significantly less in their account. They'll have $566,764, which is still a good amount of money. But when you consider how much you could have had if you had opened that account 10 years earlier, it's almost half. And so I'm in a similar boat. I opened my Roth IRA earlier this year when I was 34 years old. And because I'd rather have $1 million in that account when I retire versus not having $1 million, I found out that there's a way that I can get around the limitation of contributing only $6,000 a year. And this is through what's called a backdoor Roth IRA conversion. And the name itself might sound a little sketchy, but I promise you it's completely legal. If you just Google backdoor Roth IRA conversion, it's 100% a thing. So how do you do a backdoor Roth IRA conversion? Well, there's two main methods that you can use. The first is by converting money that's in a traditional IRA into a Roth IRA. And so there's no limit on the amount of money that you can convert through this backdoor conversion method. So if you have had your traditional IRA account open for a couple of years already and you have $20,000 in that account, then you can roll that entire $20,000 into your Roth IRA. You will have to pay taxes on the money that you contribute through a conversion because your traditional IRA contributions are going to be pre-tax and your Roth IRA is after tax. So keep that in mind if you are planning to do a conversion and it's on a larger sum of money. Then just understand that when you do your taxes in April, you will be liable for that $20,000 because that's being considered as income now. So you didn't pay taxes on it previously, you'll have to pay taxes on it when you file your taxes. But depending on your situation, it might make sense for you to pay those taxes now, especially if you're in a lower tax bracket now than you expect to be in when you retire. It makes sense to pay less taxes on the dollar than you would be responsible for later on in life when you're in a higher tax bracket. The other method of doing a backdoor Roth conversion is by converting after-tax 401k contributions into your Roth account. And this is the method that I actually used because my work lets me contribute the normal pre-tax 401k contributions, but it also lets me do after-tax contributions. And once I realized this and I realized how easy it is to do this conversion, it was kind of like a no-brainer for me because I've already paid taxes on that money anyway. So why wouldn't I just roll that money into a Roth IRA where I can now not pay taxes on any interest that's earned and potentially be able to access that money earlier than 59 and a half. Now, there is one limitation to money that's converted into a Roth IRA through this backdoor conversion. And basically what that means is that even if you're at the age of 59 and a half and you've contributed money into your Roth IRA through a conversion, then you still can't touch that money for 5 years. So that's why it's important to also have other sources of income in retirement. For me especially, because I plan on contributing money through this backdoor conversion, I want to make sure that when I do retire, I have some source of income. So once I hit the age of 59 and a half, I can start tapping into the money that's in my traditional 401k while I wait out the 5-year blackout period from any money that I contributed to my Roth IRA through a conversion. And so just like I mentioned earlier, there's no limit on the amount of money that you contribute to a Roth IRA through a conversion. So by putting the money into my 401k first and then rolling it into the Roth IRA, I can actually convert as much money as I want in a year. So my plan is from the age of 34 to 65, that's 31 years of contributions, I'm going to contribute $10,000 a year. And that will give me just over $1 million in my Roth IRA when I retire. So I know I covered a lot, so let me just quickly summarize. A Roth IRA is a type of individual retirement account that you contribute after-tax money into. The IRS limits the amount of money that you can contribute into this account, and it also limits who can contribute based on your modified adjusted gross income. If you are one of the people who either can't contribute because your income is too high, or you just want to contribute more than the $6,000 limit, then there's a loophole to get around both of those clauses, and that's what's called a backdoor Roth IRA conversion. And like I said before, this is a completely legal way for you to build your tax-free nest egg for when you retire. If you have any questions on anything that I've covered in this video, or if you have any specific topics that you'd like me to cover in the future, then go ahead and drop them in the comments below. I do my best to respond to every comment. And while you're down there, please do me a huge favor of liking this video and subscribing to my channel and turning on the notification bell. It really does help me a lot and will allow me to continue to bring you great content just like this. Thank you so much for watching, and I'll see you in the next one. What do you think, Penny? Should people open a Roth IRA?